Good morning and welcome to what is our final day of financial accounting for the spring 2022 semester. This is our review class, and so we're really just finishing up the last couple items that we haven't done already. So first thing I wanted to remind you is in Blackboard, in the reference materials folder for chapter 14, you will find this snip from our textbook. It's exhibit 13. In the textbook, it is page 710 and 711. So that's how far we are in the book, in case you need to hear that. And I just snipped it out of the book to put here so that you had it for easy reference. These are all of the formulas that you need for this chapter. And these are going to be very important for us in a few minutes when we get to the chapter 14 problem. We have two items that we're going to be reviewing today in class. The first is exercise 9 from chapter 14. In class on Monday, we had finished letter C and D. Those were the two that were new to this exercise. And so we're just going to quickly go through A, B, E, and F. Those are the ones that are review. We had done those same calculations in an earlier exercise. And so we're just going to go through those to make sure that you've got those. And once we do that, we will flip over to the chapter 14 problem, and we're going to do a complete review of the chapter 14 problem. So let's start with letter A, the ratio of fixed assets to long-term liabilities. So this $3.2 million represents our fixed assets. So $3,200,000 as a ratio compared to our long-term liabilities. And so looking at our liabilities here, we can see that 1 million are current and 2 million are those notes payable due in 15 years. That makes them long-term. So 3,200,000 divided by 2 million. The ratio then would be 1.6. Next, we have our ratio of total liabilities to our total stockholders' equity. So our total liabilities are 3 million. Our total stockholders' equity is 5 million. So 3 divided by 5, the ratio here would be 0.6. For return on stockholders' equity, the calculation is net income divided by average total stockholders' equity. Again, we have, in case you're wondering where I'm getting those, all of these formulas are here in Blackboard. So right here, net income divided by average total stockholders' equity. So here's our total stockholders' equity from the end of the year, but it doesn't tell us what it was at the beginning of the year. We might need to figure that out. Let's see what So it tells us the equity didn't change during the year. Let's see where it tells us. Oh, okay, yep. So it tells us that the stockholders' equity, the contributed capital pieces, did not change during the year. And so to find our equity from the beginning of the year, we need to take the retained earnings from the beginning of the year and add to the, add the contributed capital or paid in capital. And so the beginning of the year equity, and I might as well just put this calculation on the screen so there's no confusion. To find our equity at the beginning of the year, it would be the 1 million in preferred stock plus the 2 million for common stock, because we're told those did not change during the year, plus the retained earnings balance from the beginning of the year. So that would be $4,570,000. So there's our equity at the beginning of the year. So in order to do this calculation, we need our average equity. Oops, average equity. So it's going to be that beginning balance plus the ending balance, which is 5 million. And then we're going to divide that by 2. And so our average equity would be $4,785,000. Okay, so once we have that, we can find our return on stockholders' equity, which is the net income which is given right there. $930,000 divided by our average equity. Then we're asked to round to 1 decimal place. Since this is expressed as a percent, that would be 19.4%. And then the last question for this exercise is return on common stockholders' equity. So we're going to exclude the preferred stock and include only then the common stock, and in the income, or in the numerator, excuse me, we're going to start with that same income, but we're going to subtract from that the preferred dividends. So it's almost the same calculation that we just did, only we take the preferred dividends out of the numerator, so that leaves us $830,000, and we subtract the $1 million of preferred stock contributed capital, and so our average common stockholders' equity would be $3,785,000. It's almost the same. Excuse me, almost the same as letter B. And again, I'm skipping C and D because we did those together on Monday. So if you need to see those, please go to the video labeled Conclusion for Chapter 14. Okay, so now we're looking at the Chapter 14 problem. If you need to still pull that up, go ahead and pause the recording until you have that ready. So in this problem, there are a couple different things going on. First, there are 2 sections where we are given a whole bunch of calculations, and we have to match that calculation with the appropriate title for that measure. So there's a section there, and then there's a section here where we have to do that matching. So what you'll notice is for each one of the drop-down boxes, they have the same formulas. Each one of these formulas is going to go with one of the descriptions. So we're not going to reuse those same formulas. What I would recommend you do is keep in mind these calculations and see what we can figure out from that. So for example, working capital we know is current assets minus current liabilities. And the only one of these that has that relationship, some number minus some other number, is that very first one. So now we know that for this problem, their current assets were $3,091,000. Before I go any farther, the other piece in this exercise is we have to fill in the blanks on this balance sheet and on this comparative income statement. And then at the very end, we have to answer a couple of questions. Those I'm confident you can do on your own. So we have to fill in some blanks here based on what we have in these computations. So I already identified that working capital must be the 3,091,000 minus 860 because it's the only one that's some number minus some other number. It has to be that one. So what do I already know? Their total current assets are 3,091,000. The total liabilities, sorry, the current liabilities, not total, the current liabilities are 860,000. I already know that must be the case because that's what went into this formula. So for filling in the balance sheet, we're going to be using formulas both from here, the liquidity and solvency, and from these profitability measures. So we're going to need to be going back and forth between those. Okay, so now at this point, I know our current assets are 3,091,000. We know the formula for current ratio is current assets divided by current liabilities, so it must be that one. Same numbers, but instead of subtracting, we are dividing. Now the quick ratio, we know is sum of the current assets divided by all of the current liabilities, and so it must be that number, or excuse me, that calculation. Receivables turnover. Again, I would remind you that you have all those formulas. So if you don't know how to calculate receivables turnover, go take a look at those formulas to see receivables turnover is sales divided by average accounts receivable. So we know it's going to be some number in the numerator divided by the average of two numbers in the denominator. And so what do we have as options? We have this one that I have highlighted right now, or we have this one. It has to be one of those. The other one is going to be inventory turnover, cost of goods sold divided by average inventory. So which would make more sense, that our sales are higher or that our cost of goods sold is higher? It has to be, we hope, that the sales are higher, and so that one would go with this and that one would go with this. So we now know that our sales were $8,250,000. Well, sales comes from the income statement. And so I can go put that number in right now. And just to kind of give you a preview, or maybe to break this up so it's not quite so tedious, so we can go ahead and complete the rest of this line as long as we're here. Our sales of $8,250,000 from this year minus the sales from last year. The first column here in the amount is the difference expressed in dollars, the absolute difference. It's an increase from 2015 to 2016, so we're showing that as a positive number. If it was a decrease, we'd have to show it as a negative. And then the percent, we take that dollar amount and divide by the older year. And so the percent, and we are asked to round to one decimal place. Interestingly, here in chapter 14, it tells you how to round. So it's the first time we've seen that. It's kind of funny. And so we're rounding that off to one decimal place. What else do we know here? Well, we have our average accounts receivable here. And so we have the ending and the beginning balances added together and then divided by 2. And what I'm not sure is whether they put beginning or ending first. My habit is to start with the ending balance. Oh, it tells us right. Yeah. If you have a choice of the two amounts, assume the first amount in the ratio is for the end of the year. And that's how I would normally do it as well. And so this $714,000 here must be our accounts receivable. And this $1,072,000 right here must be the inventory. Now we can fill in another piece as well. We said the quick ratio includes only part of the current assets in the numerator. And the part that is included there are the financial assets. So it's these first three: cash, marketable securities, and accounts receivable. So if we know the total is 1,866,000, we can find the marketable securities by subtracting those other two amounts. By subtracting the cash and the accounts receivable. We can also now fill in the prepaid expenses because we know the total current assets and we know all of the parts that went into it. So if we subtract each one of those individual parts from the total current assets, we will find the one that's now missing, prepaid expenses. That's all we can do for now. Oh, no. So the inventory turnover calculation was cost of goods sold divided by average inventory. So we also now know the cost of goods sold, which would come from the income statement. We go down to the income statement, we have our cost of goods sold. We compare that to the beginning of the year. And then express that as a percent of the total from the beginning of the year, rounding to one decimal place. And we can now find our gross profit, which is of course sales minus cost of goods sold. Find the change in dollars. It was an increase, so we're showing that as a positive. And then divide by the number from the beginning of the year to find the percent increase. Okay. Let's see what we have next. Number of days in receivables. And so the formula they use here is going to be based on the one that we are given in the book, not the shortcut that I used for you in class. And so number of days sales in receivables using the formula from the book is average accounts receivable divided by average daily sales. We already know the average accounts receivable calculation because it's the denominator of accounts receivable turnover. And so this must be the number of days sales in receivables. There's nothing new in that equation that can help us in the balance sheet or the income statement because we've already done those. For number of days sales in inventory, again, it's going to be the denominator from inventory turnover is going to be the numerator in number of days sales in inventory. So it must be that one. Ratio of fixed assets to long-term liabilities and ratio of liabilities to stockholders' equity. So we have used up most of our formulas at this point. We have, looks like these three bottom ones left. So fixed assets to long-term liabilities. So we have long-term liabilities in the denominator. And then for the next one, ratio of liabilities to stockholders' equity, we would have the total liabilities in the numerator. So this one with the 1690 in the denominator must be the long-term liabilities because this number in the numerator, the 2,550,000, is bigger than this. So total liabilities has to be bigger than long-term liabilities. And so that must be the correct order for those. And then finally, times interest earned. The calculation for that is what I referred to in class as EBIT, earnings before interest and taxes. So we take the income before interest expense, income, the operating income, income before income tax, and we add back the interest expense and then divide by the interest expense. So what do we know now? Interest expense is $127,000. Come down here and put that in. And while we're here, we might as well do this other piece. Makes it a little less tedious if we give a little bit at a time. Okay, so an increase of 5.3% in our interest expense this year. What else do we now know that might be helpful? We know our long-term liabilities is $1,690,000. So now we can find our total liabilities by adding those two pieces together. Anything else we know? We know our fixed assets, $2,690,000. That's our property, plant, and equipment. So we can put that in. We know our total stockholders' equity is $4,055,000, so we can put that in. Oops. I think that's all we can do for now with those. Oh, nope, we know our income before income tax expense, or our operating income, $970,500 from right here. So that, of course, is part of the income statement. Go down and put that in. If we take that and add back the interest expense, now continuing to work backward, our gross profit minus total operating expenses would be the operating income. So we can find our operating expenses by taking the gross profit and subtracting the operating income. Now we know our total operating expenses and we know how much was administrative. We can figure out, we can subtract to determine how much was selling expense. Oops. To be consistent. So now we can go ahead with the remaining calculations here, all the way down to income tax expense. I'm going to pause the recording and let you fill in those. Okay, so I've filled in everything else that we can calculate at this point. We have just a little bit more to do on the income statement. I just wanted to point out to you that we do have a couple lines where the 2016 value is lower than the 2015, and so it is important that you show those as a negative to show that's a decrease in that amount. Okay, let's go back up then and see what we have. We've finished the top part. We've done everything we can up to this point in the balance sheet and the income statement. So let's now go to the profitability measures. Looking at our formulas then, asset turnover is sales divided by average total assets excluding long-term investments. We already know what the sales number is because we needed that for one of our earlier calculations. So we know we're looking for $8,250,000 in the numerator, and this is the only one that has that. So what else do we know? We now know that the total assets minus long-term investments is this number, $5,781,000. We don't yet know our total assets, but we'll come back to that. We're going to need that number, this $5,781,000, which is the total assets minus long-term investments at the end of the year. Moving on then, our next calculation is return on total assets, and that formula is net income plus interest expense. We already know the interest expense is $127,000, and so this is the only one that could be the net income plus interest expense. So this gives us our last piece for the income statement. This 127, oh no, that's the interest expense. I take that back, scratch that. This number right here, the 786,300 is the net income. 786,300 is the net income. I just started talking about the wrong one. So now from there, we can finish up the income statement piece. And again, I'm going to pause the recording and let you fill in all the rest of these income statement calculations. Okay, so I filled in the last lines on the income statement. Again, you'll notice that anytime there's a decrease from the earlier year, you need to show that as a negative. And let's go back to our exercise. Now, what do we know? We know, I'm just going to put a little box here so I can make sure you're seeing the same numbers that I'm pointing to. So we now know that this is our total assets, and that this number is our total assets minus long-term investments. So if we find the difference between those two numbers, that will be our long-term investments. So let's go to our balance sheet. We can put in our long-term investments. Oops, just type that into my calculator instead of into the problem. And we also know our total assets, but we could find our total assets by adding up the current long-term investments and property, plant, and equipment. But we have it right here, $6,605,000. What else do we know? On the balance sheet, total assets is equal to some other number. In chapter 1, we learned the fundamental accounting equation. We know that total assets must be equal to total liabilities plus stockholders' equity. So we can take that number down here as well. We don't yet know retained earnings, preferred stock, common stock, or retained earnings, but we'll get there. Our next calculation that we're looking for is return on stockholders' equity. That is net income divided by average total stockholders' equity. So we know our net income was $786,300. We know that's what we're looking for in the numerator. And then we divide that by the average of two numbers. So that's this. Has to be. Nothing there that we don't already know. Next number is return on common stockholders' equity. It starts with the same calculation as return on stockholders' equity, but in the numerator we subtract the preferred stock dividends of $65,000 in this case. And in the denominator, we subtract the preferred stock contributed capital. And so the difference between, I'm going to box these so to make sure you're seeing this right, the numbers I'm talking about. This is our total equity. This is our total equity minus the preferred stock. And so if we find the difference between those two numbers, that will be our preferred stock. The paid-in capital on the preferred stock is the difference between those two numbers. Next, we have our earnings per share on our common stock. And so the numerator is the net income minus the preferred dividend, and the denominator is the number of outstanding common shares. So we now know that there are 250,000 common shares, and they each have a par value of $5. So 250,000 shares at $5 would be $1,250,000 that must be in that account. We can then find our retained earnings because we know the total stockholders' equity is $4,055,000. We know how much of that is for preferred stock. We know how much of that is for common stock. And so whatever's left must be the retained earnings. So we have now finished the balance sheet. The PE ratio is the price of the stock divided by the earnings per share. And the dividends per share is the dividend per share divided, the dividend per share divided, The dividends per share is the total dividends divided by the number of shares. Dividends yield, was what I was trying to say, is the dividend per share divided by the market price. So we have now finished both sets of computations, plus the balance sheet, plus the income statement, and we can go ahead and answer these final questions. Your accountant friend reveals that the company whose information you've been working on is actually a company he's thinking of investing in. What advice and insight do you have for your friend? Using only the information from the horizontal analysis of the comparative income statement, that's this. Complete the following sentences. So what has decreased significantly? Well, their income did. Both their income before income tax expense and their net income decreased significantly over the 2 years, even though sales increased. So sales went up by 13.7%, but they made 18.2% less in income. Why is that? Well, cost of goods sold went up by 19%. Their selling expenses also went up by, their selling expenses went up by 25%. Their total operating expenses went up by 19%. In the same period that sales went up only 13%. So, however, cost of goods sold has also increased, which slowed the increase in gross profit. So gross profit only went up by 8.8% because of that bigger increase in cost of goods sold. In addition, selling expenses has increased at a faster rate. It went up by 12.1%. The company appears to be struggling. Based on these observations, do you recommend that your friend invest in this stock? My answer based on this is going to be no. But one final comment, as we said in class, you don't want to just rely on one piece of the puzzle. We'd also want to be looking at a comparison for these profitability measures, for these liquidity and solvency measures, comparing those results from last year to this year to make sure we're getting the full picture. To look at only this comparative or horizontal analysis of the income statement might be misleading. Now, we answered the questions as we were told, looking only at that information, but I just want you to recognize that's not the only information that's out there, and it's not the only information that's relevant for this decision. I'm going to stop the recording now. So when I hit the check my work button, I see that it says that it doesn't want you to say, no, you shouldn't invest in this stock. It wants you to say, yes, you should. I question that when we've just gone through saying the company appears to be struggling. Yes, they're still making money, but it's less than last year. So they must be basing this answer on something else, or they're not really paying attention. So just wanted to make that last observation. And now I will stop the recording.